Hey folks, welcome back. We're looking at the dollar index as a seasonal tendency. And as we went through the mentorship, this focus of the strongest seasonal tendencies was one of the primary reasons for referring to seasonal tendencies at all. And while they are not a panacea, they are very good roadmaps. And it was my intention to at least stimulate your thought processes around the idea of looking for those very routine, repeating seasonal tendencies. And if you go back and watch the high quality, I forgot what I named it actually, the best seasonal tendencies, the ones I focus on, you'll see that this is one of those in the list. We have a seasonal tendency for the dollar index to create a low around the last week of September and first week of October, as depicted here. If you look at the red line in here, this delineates the 15-year seasonal tendency, and the blue line delineates the 33-year seasonal tendency. They have a denotation for 5-year, but it doesn't appear on the chart. So the importance is the correlation between the 15-year and the 33-year average. When they both agree and it shows a strong turn, that to me signifies something that warrants our attention, or at least it warrants my attention, let's say it that way. So I believe when it's bullish or extremely bullish, we could see a low form as early as 21st or 20th. This is rounded to an even number because my OCD flares like that, but the seasonal tendency here shows the 21st of September. Now, on weaker years, in other words, when it maybe isn't so bullish, if you will, it may take as late as mid-October to show the seasonal tendency to come to fruition for bullish dollar. With that said, it's not important that we split hairs about the specific date, because it just gives us a window of opportunity to look for technicals to come in alignment with that. So this price action model really is just going to bring the things together with a real example that we've watched and followed through to completion using the Swiss franc. So if we go to the Swiss franc seasonal tendency, let's do that now. Okay, so we can see the Swiss franc, the seasonal tendency showing a important high forming again the last week of September and going into October, shown here. And I really didn't want to put my cursor because you can see it draws those crosshairs on it, but I wanted to use this chart because it's much cleaner looking versus the PDF format that comes along with this seasonal tendency from more research. So looking at the likelihood that we would see a stronger dollar seasonally and a weaker Swiss franc seasonally, it goes without saying that the dollar-Swiss pair in Forex should warrant a rally of some sorts. But we have to look for things from a technical standpoint to support that idea. While we do have the macro seasonal tendency here, we have to look at what are the smart money traders doing. So now we're going to bring in the COT data and the hedging program that I taught through the mentorship. Okay, so we're looking at the December contract for the Swiss franc. Price action shown here is daily, and what I have plotted is the COT data for the commercials, and I removed the small specs and the large funds just to keep our focus on the commercials. And a few of my students, and I appreciate this by the way, they said that you could go to barchart.com. You got to sign up for an account, I think, to only make this work. And then once you create an account, I just link mine through Twitter, so you can sync it through your Twitter account once you sign into Twitter, go up to, usually is up here, like login or create an account. Just create an account linking, signing in with your Twitter. And it's pretty quick and easy, painless. But then you go over to interactive chart and you load up this symbol here, S number 6, Z as in zipper, 1-8. That will give you the December contract here. Then you would go to studies, click on that, add the COT. Commitment traders. As you can see, the little eyeball is dark here. That means that the commercials are the only ones being shown. If I wanted to add the large specs back or the small specs back, I would just tap the eyeball like that. Okay. So since I don't want to make any changes, I'm just going to come back out of that. And now once you have this chart here, what I do is I get the highest reading in the data, which is about 67,800 and some. It doesn't have to be perfect. Okay, it's not that you have to have the exact number. And I get the lowest reading, which is over here in the last 12 months. And then by having that range, I just go into the middle. Now you can do it mathematically. You can take the high and the low and determine what that middle is and then plot it. But again, I don't go crazy over it. You can if you want to. It's one of the few times that my OCD doesn't really flare up. It's not that imperative that I'm that precise about what we're looking for. But once you have this information, then you can go over to an application like Paint on your computer. And if you want to do this for your own records, I just do it to highlight it so you guys can see it graphically and clearly. But as you can see, we're going into the last week of September, going into October. Price makes a rally. Now, price action model number 6 is focusing on the fractal, which is the market maker buy model and sell models, focusing only on the buy side. Okay, so the futures contract, you can see in here, the commercials over the last 12 months, even though we're not really looking at the zero basis line that's traditionally used for COT data and analysis, what I look for is the 12-month range, and 6-month range, and a 2-year range, and a 4-year range. But for the near term, the 12-month and sometimes the 6-month is just enough to get your quarterly shift expected bullish or bearish. Okay, so you can get a read on the commercials more accurately, in my opinion, and you'll have to go through the data yourself to convince yourself. Don't take my word on it. It's much more powerful when you see it. But you can see there's a major accumulation phase in here. Commercials were heavily long relative to its 12-month range. Okay, so the highest high and the lowest low, they were already factored by March to July, okay, going into August. So this swing below the range high and the range low, that's a shift in their sentiment. In other words, they're doing a lot more selling on a net basis than they are buying, even though this whole process of the data is still classically viewed as net long. And that's the reason why retail traders get whipsawed and, well, for lack of a better word, crushed using COT data. They put too much emphasis on whether they're bullish or bearish relative to that zero line. And to me, I think that zero line is a red herring. They're giving you enough data to say, look, we're being transparent, we're showing you what our positions are, but they're skewing the data. So it's kind of like, if you ever watched that, it's kind of old, and only the big people that are probably in their 40s would remember this. But on TV in the States, there used to be a program every year. David Copperfield would do this whole hour show of different, magic tricks and such. And one of them, he made the Statue of Liberty disappear, or so he said. But really what it was is you were looking through a picture frame, and the camera and a small select group of spectators were forced to view the Statue of Liberty through this picture frame, and had a wall around this. So you were limited to only seeing that Statue of Liberty or point of focus through that picture frame. Then he closed the curtains and then opened them moments later, and you can see that the helicopter that was flying around that earlier is flying around an empty space. Little did you know that the camera, because it's on the same pedestal that the small little section of audience members were sitting on that were connected to that window, all he did was shifted the entire platform a few degrees to the left or right. I can't remember which one it was. But when you open the curtains up, you look through that small little space of the window, and your perspective would convince you quickly that, what? The Statue of Liberty disappeared. No. All he did was skewed the information. He gave you something to look at. Well, this is what I believe the COT data does from a classic interpretation. They show you just enough, but the information is really only usable when you look at it in terms of, well, think about what the data is telling us. Okay, we're tracking the buying and selling of three groups. Small specs we're not concerned with because they're typically wrong. Large funds or large specs, they're classically right in trending moves, but they're always wrong at the tops and the bottoms. The tops and the bottoms are always called by the commercial traders. So if we are focusing on the commercial traders, we'll know with a great deal of certainty, not absolution, but a great deal of certainty, that the ebb and flow of price action will be more or less dictated by their actions. So if we see a net long position here as shown, we could reasonably expect to see some bullishness come into the marketplace. We see a consolidation, the market leaves the consolidation, comes back to the consolidation. There's our return to the market maker sell model. Rallies up, another buying opportunity. So it's a reaccumulation, accumulation, reaccumulation, smart money reversal, low risk sell, redistribution, redistribution, clearing the consolidation out over here. But the focus is right in here. This is what I want to bring your attention to. So price action model number 6, what we're looking for is a high probability condition that repeats just about every year, and that's why it's framed on what I taught in the mentorship by way of looking at the seasonal tendencies. We've already framed out the last week of September going into October, bullish dollar, bearish seasonal for the Swiss franc. So now we have, at that same time, the COT hedging program application that I use for COT data, which is only taught here. This gives us a sell program. So we're seeing a heavy distribution in their net longs, but more importantly, over the last 12-month range, it gives us like a typical oversold to overbought range, like an indicator. But the only thing I did was use the data to measure their real buying and selling, and not using that forced perspective of are they net long or net short basis like the traditional retail perspective teaches. Okay, there are times when that is useful, yes, but predominantly I go to this before I even consider the net long or net short basis traditionally seen with the COT analysis. So now with that information, let's go over to the dollar CAD pair for Forex and pull out some information relative to price action model number 6. Okay, so we're looking at the dollar Swiss. This is the monthly chart. And again, I'm going through the same progression that I taught in the mentorship. Go back and look at the position trading, the swing trading, the short-term trading, the day trading, and the scalping lessons, and how we started those lessons from which chart goes to what time frame lower in that typical progression towards a top-down approach. Okay, so with that said, we're looking at the monthly chart here of the dollar Swiss, and this candle right here. Okay, there's our September candle. The low comes in at 95.42. Okay, 95.42. That's essentially about midpoint or the mean threshold of this last down close candle that cleared out these equal lows. So all we're doing is using the PD array matrix, and are we looking at a premium market or a discount market? At this moment here, when price trades down, that is a discount market. Where should the market reach for? Well, we have equal highs here, we have equal highs here, we also have equal highs here. There's a large draw on liquidity here above these equal highs, and we trade it back down into the mean threshold of an order block, that would be deemed bullish. Also, we already cleared a level of stops, so therefore this retracement should not come back down to this level here because we've already cleared a level of sell side liquidity. The market will look to expand to a buy side liquidity, or in other words a liquidity pool above old highs. So we would be looking for in September and going forward a rally of some sort around that 95.45 to 95.50 level. So that's our rough idea. Okay, 95 mid-figure, let's just call it. And that's just a guesstimation, and that's how you would have done it before the actual low was formed. Also, we have this buy side imbalance from this candle's high at 95.84. Okay, so we could reasonably expect to see that trade down to that as well to rebalance this buy side imbalance with sell side delivery. Okay, so we're going to drop down into a weekly chart and get a better read. Okay, so now we're looking at the dollar Swiss on a weekly perspective, and we see that as equal lows that were rated here. So the price should not continuously drop down here. So for those that we question, well, how would you know to anticipate a buy here and not see it trade down to here or trade down to this order block right here? We've already done the work by running the sell stops over here, and they aggressively moved away. Your eye goes to what? Again, think the PD array matrix. This down close candle is a bullish order block. Price should trade back down into that. The open on this candle is 95.47. Okay, so 95.47 is the level we'd be looking for. Remember, we started with 95.50 mid-figure relative to a monthly bullish order block, the mean threshold. Then we dropped down to a weekly and we refined it even further. Again, not getting caught up in all of this drop down, thinking, okay, it's the end of the world. We're leaving these empty highs up here with all kinds of liquidity resting above that, and longer term going back to the left, as mentioned on the monthly chart. If you look at the data in terms of discount to premium, we are in a discount market here relative to the high and the low. Okay, so we're at equilibrium to discount, and we're also at a PD array in the form of a weekly bullish order block. So if we add our data, we add the order block. Now the question is why am I not using the wick here? If you look at all the price action here, we had this wick, we had the body trade down through it here, we had it wick down into it here. So to me, the body is the more focal point because of its only single down close candle here, and then it's all up. So this is where institutions bought, and the algorithm will want to go back to that price point to allow more opportunity to go long. From a longer term perspective, so for position trading, you would wait for this opportunity here. Now in terms of the market maker sell model, which would be seen here as consolidation, rally away, return to the consolidation, reaccumulation, rally up, distribution, reaccumulation, distribution, and then a longer term correction, this would not need to come down here to clear this original consolidation over here, because the narrative is these equal lows have already ran out over here. So the stops are gone. Remember, the bullishness of the dollar seasonally and the weak seasonal tendency for the Swissy is occurring September, October. So we're going to expect to see this pair dollar Swissy rally. And the underlying narrative is there's liquidity resting above these highs. And going back further to the left relative to that monthly chart, as mentioned moments ago. So this is where the market maker sell model picks up buying. Remember, where there's times where the distribution cycle doesn't go redistribution, redistribution, then clearing the consolidation. Many times it'll accumulate over here in terms of the directional bias. And that's what we saw here. Now the 95.47 level, this opening price of the down close candle, That's what we see here. And we're going to move over to this candle and get the actual low. The low comes in at 95.42, so we're only off by 5 pips using a weekly chart. So we're going to drop down into a daily. Okay, so now we have our daily chart here. Now we have a little bit more detail in terms of looking at what we would be expecting for shorter term trades. In other words, swing trades to short term. We have a really nice equal high in here, so buy stop liquidity pool resting just above there, as noted and has been shared before the fact back here. We had price come back to the consolidation here with an up close candle, so they sold into this and then distribution came in. They sold into this rally, distribution one more time, they sold into it, and distribution, making a smart money reversal, then a low risk buy right here, right in here. So we're going to look at a 4-hour chart in a moment, but say you missed this one, okay? You can be a day trader after this day here because there's indecisiveness, but we already know the backdrop and narrative is we're at a weekly bullish order block with liquidity pools resting above the market during a seasonal tendency for the dollar to rally and twist the fall. So we could be using power 3 on this day here, trading, expecting the low of the day to form initially and then expansion on the upside for these equal highs. And I tweeted at the time to look for these highs to be taken out, and we saw that happen the very day it was tweeted. Price then continuously moves higher. Okay, so you can use a day trader's model getting in here, but using the narrative that that could be a short-term trade entry, looking for these highs to be taken out and then up into this candle here, waiting for it to rally through this up close candle, because this up close candle, because it was a sell side of the curve, in other words, this low here, everything to the left of it, any up close candle should support price on the right side of the curve. We're buying in this up close candle here, right in here. We should expect to see upside expansion. We see that. The next day we open, trade down. Why did it do that? We return back to these up close candles here and here. Because they sold here, they're going to mitigate that with this drop down. That's what's going on. So this is an area to buy. Again, not requiring the market to come all the way back down to here. It's not essential. This is enough to get a buy. Again, using power 3, expansion on the upside. Once this candle has been traded above, over here, we expect to see a retracement back down into this candle, because again, this is the distribution where they sold. When price gets it back above it later on, think how the commercials trade. They do a lot of hedging, so they can buy in here and sell. So the positions that they're short on, they can mitigate that, and they don't have a loss now. The positions that they bought, they want to add to. They do it right here. If we add a range, here's our up close candle. Draw that out across the curve. And boom, there we go. Price dips down into it, picks up more orders after closing in an imbalance. The high to low, so we have a fair value gap right in here. Price comes down to fair value. One more time, runs the stops. Then expansion on the upside. Equal highs have been taken. Equal highs have been taken. The day trade entry that you use down here, you take profits off here because you could be wrong. If price trades above here, take a little bit off, and as price trades down again, you buy more. So you add back a little bit that you took off here, because that narrative is being further built upon. This raid below this low here, we don't see that as a market structure break to the lower end or downside. Why? Because the narrative has not changed. We have yet to take out the equal highs here and on the weekly and monthly. That buy side liquidity pool or pools are still intact. So that's where the draw of liquidity is. So when we see the market trade below an old low, how we're using this price action model is we're using the higher time frame fractal with the seasonal tendencies and the narrative that those buy stops in the form of a liquidity pool resting above equal highs on the weekly and monthly. That's the long-term draw, because the commercials are in agreement with that relative to the hedging program that I showed with the COT data. So when we see this low breached, we could be a buyer of that. Okay, so we can trade this in terms of buying external range liquidity, buying up the sell stops on a turtle soup type move, and then rally away. Price takes out these equal highs. You can take a little bit off there to pay the trader, and then price creates another retracement lower. Price expands, trades through it. We open, trade down into the order block again, pick up more orders, and then expands into the upside. This to me looks like just near-term profit taking. I don't think we're done. If we do trade below these lows here, then it's going to be problematic for the overall fractal. But from a swing trader or short-term trader that use this entry here, the stop loss would be moved below that low here, because it's already been defended once, twice after a stop run. Now this is a good level to put your stop below, because we've already done the work. If it trades back down to that level, it's no good. Okay? It doesn't mean it can't go higher later on. It just means that, position management, it's just good practice to do that. Now, what does that mean for a trader that wants to be a day trader? We already went through the position trader's entry using a day trader's model for a short-term trader, and we looked at other short-term entries in here. But as a day trader, look at how many days we have relative to the open and the low being near the low of the day. In other words, the large range days. The low is formed very often with a very small wick to the downside, and the majority of the ranges are on the upside with expansion. That's the fractal in formation and the delivery of price. We've used the macro element of higher time frame, seasonal tendencies, and COT. So we blended those three pillars, which is smart money, the higher time frame narrative, and institutional order flow. And we blended them with a clear repeating phenomenon, the market maker buy and sell models. They're very clear. They're not ambiguous. The things that we see on the left side will be applicable on the other side. In other words, wherever we see the turn, the smart money reversal, it's not imperative that you get that. So if you see it in hindsight, it's okay, because it still gives you all the information. So, okay, if I miss this low and it starts to rally here or it rallies here, who cares? You know that these up-close candles here are where the work's going to be done going forward, attacking the liquidity above the market. It's as simple as that. Now, notice that it's framed on a seasonal tendency that we went over in the mentorship. That means that you're going to be waiting for these to set up, and then you're going to milk them for everything they're worth. You can't take blood from a turnip, obviously. You can't just go in here and willy-nilly just trade anything you want. You want high probability conditions, you want high probability setups, and the way you get those is using the seasonal tendencies, the commitment of traders data to support the idea. Are the commercials in fact doing what we'd expect to see them do? And then the technicals get in alignment as well. So we're blending those three elements of commercial, smart money, interest, the seasonal influence, should it take place, and then institutional order flow using the PD arrays and the PD array matrix. Everything's here. Nothing is missing. And you saw me outline it, on Twitter. I pointed everybody's attention to it. The general public that follow me on Twitter, they have no idea what's going on. So if I were to post this chart, not like this, but if I said, market maker buy model complete, in their mind they're thinking, okay, now it's time to sell it. That's not true. What we're looking for is a continuation of this narrative to reach for those weekly equal highs and or longer term monthly weekly highs. So From a position standpoint, long term, you'd buy down here, okay, or you would look for an opportunity in here to get long, and then you would use your low here as a stop, or you could use the lows here as a stop because this whole work is done. There's been displacement now. The elephant has stepped in the children's pool. The water has been displaced. The evidence is there. They're in the market to to take it higher. If we wanted to go even further, we can drop down into a 4-hour chart. Okay, so we have a 4-hour chart. Everything's still the same as it was shown on the daily. In here, we have the last down close candle. That down close candle is seen here with an open at 95.75 and a high of 95.78. So if we traded down to 95.80 to 95.78 in here, after running through it with this candle, we could be a buyer. Now this candle here, the low comes in at exactly 95.78. We could use that as our entry point, bullish order block, stop below here, and that could be your position entry. That could be your short-term entry. It could be your swing trade entry. It could be just a simple day trade as well. But looking at this price action here, you can see clearly the equal highs here, and then we already noted over here, this would be the next draw on liquidity. So any entries that you take in here run below this low here, what would that be? Obviously, we have the benefit of hindsight, but again, the narrative is we're looking for those weekly and monthly equal highs to be taken out because we're inside of a bullish seasonal tendency for the dollar index. So anytime price trades below the lows, what is that? It's a turtle soup long. Okay, it's external range liquidity. They're running the stops here. If it runs below there, we expect to see acceleration to the upside. Does it show it? Yes. There's a signature right there. So now we know we're on the right side of the marketplace and we're following smart money. And then we have another retracement back down into an area of liquidity. So they ran the liquidity, take it back a little bit more, buy more, acceleration on the upside. Now we're in this area. Look what we've done. All of this is that daily up close candle where they sold short on the left side of the curve before we reversed it here. So now they're mitigating all that. That's why they held it in here. Mitigation, mitigation, mitigation. They're covering the shorts and adding more longs, but they're doing it in small portions because they don't want to tip it off. Expansion on the upside, reaccumulation, reaccumulation after running equal lows. Now think, if they're going to run below the equal lows, like they do here in an area of mitigation relative to that daily chart, what should we see after this stop run on these stops right here? Acceleration to the upside. Small little acceleration or energy. It should be energy behind that move. And you see that here. Okay, it runs the equal highs, reaches for liquidity, ultimately sweeping above the short-term equal highs mentioned on Twitter. So we have many examples here, but we're going to take it even further. We're going to drop down into an hourly chart. Okay, so we're looking at the hourly chart. I'm going to add the day dividers in here. And every time we see the double line, that's a Sunday. So the next area is Mondays, Tuesdays, Wednesdays, Thursdays, and Fridays trading. The return back to the order block in here on a Monday. And then we had a Wednesday stop run below here. So we're focusing on what? If we're buying, we want to be a buyer on Monday, Tuesday, and Wednesday. Wednesday, we have a run on stops from Tuesday's trading of that week. That is not a market structure break to the downside. Retail is going to see that as resistance. That further sells the idea to me with the market efficiency paradigm that all we did was run the sell stops on trailed stops that maybe someone that bought low here or bought in here, their stop loss is going to be trailed to here. They wick through that, run their stops, and then we see that energetic run to the upside. We have the low of the week form on Monday here, consolidation on Tuesday, and then Wednesday, expansion. And then we have a Thursday consolidation week with equal lows formed, rolled into the following week. Look what we do. We drop back down into equal lows, and on a Monday. So we pick up the same narrative, buying on Monday, Tuesday, and Wednesday. Monday we buy. Tuesday we have a retracement back in the order block, running stops again. We don't see that as a break in market structure. We don't see that as a bear flag. We don't see that as a bearish market coil where it should break down. We see that as buying, sell stops, expansion to the upside. Next week we have Monday's low here, rated on Tuesday. Once we see that trade below that, did we see that as a market structure break? No, we see that as buying as sell stops, and sell stops have been taken. We expand on the upside, and that's what we see here. So if we add all that information from the Twitter, zoom out a little bit, there it is. Price action model number 6. I will talk with you again in price action model number 7, which will be just the opposite shown here, and another pair. Until next time, I wish you good luck and good trading.